Ronald, and everyone who has joined us this morning. It definitely demonstrates that you're very interested in learning more, networking, and getting to see how you can improve your business. Just as earlier introduced, I am the team leader and founding partner at Outbox. We are what you would call an innovation and entrepreneurship support organization that is focused on supporting early stage small and growing businesses that demonstrate the potential for scale, sustainability, and impact. Our role is quite simple. We make sure that we are able to bring the capital, the infrastructure, the knowledge, and the people that can help your businesses to succeed. We started in 2012 and have been on this journey over the last 11 years now. So we are one of the oldest entities out there supporting entrepreneurs. Currently, we are one of the entities with the largest aggregation of grant financing for small and growing businesses. We have an initiative, the largest is with NSSF and MasterCard Foundation, known as NSSF High Innovator, where we are focused on supporting up to 500 small and growing businesses with up to $10 million technical advisory and linkages to markets and finance. Currently, we are at about 120 businesses that we have currently onboarded and working with 11 other innovation hubs. We have other initiatives with World Food Program, where we run the Ignite Food Systems Challenge that's focused on supporting businesses in food security that are addressing food security challenges, where we are deploying $300,000 to 7 businesses at the moment, and are soon going to launch another call where we can onboard 6 businesses with tickets worth $50,000. We also have other initiatives with USAID, where we are supporting farmer producer organizations, building their capacity and linkages to finance, and also deploying risk capital. Now, you might wonder why, all these small tickets and everything around trying to deploy some capital on top of business advisory for businesses. And I believe that's why our venture capital topic is very, very important. Some of you may be hearing about this for the first time, but we know companies raise money in 2 ways. You either raise money from private investors or you raise money from public investors. Public investors is where you go and you're big enough to list on what they call the stock exchange, like Uganda Securities Exchange, like what MTN did recently. Then private investing, which is what you call private equity, is where institutions, individuals have come together to deploy some investment into businesses. And that's what we call private equity. But in there, we have the venture capital side of things that is largely geared towards supporting early stage businesses that demonstrate the scale for growth and sustainability. And venture capital, in its own sense, is filling a small gap that businesses face. As you know, when you're very, very early stage, you either have an idea, you have a product, but you're very risky. If you look at where you would traditionally go to get money, like a bank, they have rules and regulations within which they play that are very hard for startups or small and growing businesses to conform to. And because of those regulations, they can only lend against hard assets, right? And then because you're considered very, very risky. Now, when you're starting out, you hardly have these hard assets. And so it's a question of where can you get some money to actually grow your business. And this is where venture capital financing comes into play. These are institutions, individuals who take a bet on you and expect a very high return. The return on investment expected is very, very high in terms of trying to make their money back. And there are also categories when you think about venture capital investing. You know, you have seed, where you have about there's even pre-seed, right? Where you have about $100,000, $300,000. Then you have seed. You can convert that to Uganda shillings by multiplying by 3,700 to get a rough idea. Then you have seed, which are now larger tickets of up to $1 million, even $5 million. And then Series A, Series B, so forth and so on. Now, as the market has kept growing, more money has been put towards venture capital. And so the brackets of the ranges in those areas keeps shifting depending on how much capital is available for different businesses. Now, you might be wondering, why should I seek out venture capital? And I think you know, you have two options. You either use your money to grow your business, or you use other people's money, right? And the beauty about using other people's money, it allows you to take risks you would not have otherwise taken with your own money. Despite the fact that you're an entrepreneur, many times you're also calculative in your approach. So you can use this money to quickly hire people you would not otherwise have afforded, or quickly build products and test things in the market that you would not have otherwise done with your market, with your own money. And also you have, it gives you some time, a long-term time horizon to pay that money in relation to any other forms of financing. So really that's the difference between venture capital and the aspect of bootstrapping, right? Now, of course, taking other people's money also has its pros and cons. I've shared an advantage, but the con is that the investor's business model can easily become your business model if you don't have an alignment in terms of the vision of where you're going. So in Uganda, we've had some businesses that have successfully raised venture capital financing. I'll give examples of some businesses we know. We have Safe Border, for instance. Those of you who stay in Kampala, Safe Border was able to grow and do all these things because it was able to raise money that enabled it to onboard riders, offer discounts. These are things you would not do with your own money, right? Offer discounts to customers in order to grow awareness and increase utilization of the platform. We have another business called Tugende, which is in the business of asset financing. So they give you a motorcycle, for instance, and then you pay them back slowly. Some of you have seen the borders with Tugende written there. So they've been able to raise a lot of venture capital financing. And even recently, if I recall, there's this business in snacks, like Newman's, that has recently raised money. If many of you have seen it in supermarkets. So for you to be able to raise a venture capital, you have to be at a certain stage. But Uganda is not doing so bad. I think on the African continent, we rank around the 10th there as of last year in terms of raising venture capital. We raised, so venture capital, the way it's tracked is there are people who declare deals, there are those who don't declare deals. So it's very hard to have an absolute number, but it's largely between $41 million to about $55 million for those who are able to declare deals as of 2022. Yeah, so in a nutshell, that's what venture capital is, and I hope it has shed light in terms of where it comes into play in the stage of your business. Over to you, Ronald.
Right. I think thanks a lot, Zulu. I think we can now get into our conversation. We will have an opportunity to ask some questions. You can put them in the chat box, or you can put up your hand and just ask. But Zulu, I think I'll ask a couple of questions before I bring everyone in. I see Patrick's hand is up. But I think my first question is, when you say a business needs to be prepared to be able to access venture capital, what do you exactly mean? What facets of preparation are key for a business to be able to access venture capital?
Yeah. Yeah, so many times, and I believe that this is very important for people to know. We believe that investors go after good ideas and good people, right? But money is largely, if you really want to know how money flows, the very first thing that a venture capitalist cares about is the industry, right? So they look at the industry that's quite competitive and an industry that's growing, right? Now, in that industry, when they come into that industry that has a proven market, their focus now is on finding that good founder or CEO that can ideally implement and take their business, right? So imagine you're looking at a proven market segment in an industry that's growing and very active, and why that is very critical for them is because they need to exit. So let me give you an example. If we talk about industry now, market and trends, you very well know that aspects, for instance, of green businesses, sustainable businesses is very critical, right? In terms of, okay, how are you having the environment at the core of how you're operating? So there's a lot of interest in that sector as far as mobility in electric vehicles, to as far as even how we grow our food, right? So that's an industry that is very attractive. For those of you who understand technology, we now have artificial intelligence, the ability of machines to learn and do tasks on their own, right? That's also a very attractive industry. And so when you look at, those are just examples. If you look at the industry you're in, that's very critical, and its ability that it has a proven market and the ability of other players to come in and then exit. That's the first thing they look at. So you're in an industry and you have a proven market. Then after, they will look at the team, right? So does the CEO understand the market? As a leader in your business, do you have the skill sets? Do you have the reputation? And can you actually sell yourself? That is also very critical. The next thing that they'll look at is, do you have a proven market, in a proven product in a proven market, right? So you must have a product, you must be selling. It is very hard to raise venture capital if you're not demonstrating either the potential to grow your revenue exponentially, or you're not making money, right? So you have to demonstrate those aspects as validation that you actually have a proven product in a proven market. The other thing that many of us miss out on when it comes to understanding where the VC will invest is, do you understand the VC you're talking to? Do you understand the investor you're actually talking to and what their fund wants to achieve? Are you speaking their language, and do you see an alignment between what you want to achieve and what they want to achieve. That is very, very, very critical to demonstrate that you understand what an investor wants to achieve and how you align with that. And then the other thing is, of course, disruption, right? VCs hardly go after traditional business models because they believe that traditional business models, after a certain time, the risk is low, meaning the return is low. So after a certain time, maybe you can qualify for the financing from a bank. So they want, because VCs are at a certain stage between the person who gave you money at the start, who could be your friends, your own investment, so forth and so on. And they're also between very large institutional investors that could potentially buy into your business. So they are creating a market, a product at that point so that they can get very high returns. So your business has to be able to show them that potential by looking at how it's different and how it's disrupting. The other is your business model, which I've just largely talked about also in line with differentiation. How unique is it? How is it offering new value? How are you doing distribution, so forth and so on? And then one of the last aspects they look at is what have you been able to do before they come into the business, either in terms of the revenues you've made, the partnerships you've signed, any forward contracts, which is people looking forward to your product or service in terms of fulfillment. So all those things are quite critical as you're thinking about talking to a VC. But the first starting point is the industry. Is the industry attractive for the VC that you're talking to? Thank you.
Super. Thank you so much. Thank you so much, Zulu. I'll bring in Patrick. Patrick, please go ahead and ask your question.
Okay, thank you, Ronald. Thank you, Zulu, for coming through to share insights, with the rest of us in the marketplace. Two questions for me. One is, Zulu, in your 15 or 20 years exposure in the ecosystem, you realize that we have so many products or services that die at infancy because the ideators don't have even their own money to move the idea to market. And the VC is actually looking at some proven numbers. As an ecosystem player, a president of Startup Uganda, and all the work that you're doing in the ecosystem, how do we leverage this ongoing ranking of Uganda being #1 entrepreneurial country, in the world or in Africa, by supporting those that are still at seed stage, not even at VC stage. The second one, as Outbox and as the team lead and co-founder, have you thought about setting out an Outbox Foundation that will take a bet on Ngolobe, who has a brilliant idea but cannot make it to the VC? Is that something that is on your mind in the horizon, and how would that look like? Thank you very much.
Great, thank you, Zulu. You can go ahead.
Okay, thank you, Patrick. And you raise a very, very, very good question. This is one of the biggest problems that we have. And let me tell you, when to create that change you're asking, it's system change. One of the things we've seen is the people who, let me call them high net worth individuals, for instance, in Uganda. High net worth individuals have some money. We also have some money in circles. We also have some money in some staff pension funds, close to 68 of them in this country, that are hinged on bigger entities, right? But these entities or sources of financing, one of the things we've seen is because of the way they are set up. They're not set up to have to deploy patient capital, right? Now, at this stage of a business, you need patient capital. What do I mean? If you go to a circle or you go to a staff pension scheme, a staff pension scheme basically means, let me give you an example. You have URA, but URA staff members come together to collect their own money and invest it, right? Those entities have a lot of money. By their very nature, they are almost set up like banks to give short-term working capital. 3 months, give me my money, give me my interest. Now, why are all these potential sources of financing that we would have otherwise leveraged to support our early stage businesses, not investing in them? Again, it's about the high risk. It's about the low returns that they think they'll get. So when we sat down with NSSF, we realized this problem and said, you know what, we have to operate at scale to prove that actually if I put money in a one Patrick Ngolove, running his small business that has potential for scale, we should be able to get back our return on investment, right? So imagine you're getting a pension fund like NSSF to demonstrate to the market that this is possible. So collectively with MasterCard, they came up with a $10 million fund to kind of prove that. And the idea behind that is to invest in the types of businesses, Patrick, you're saying, which we are doing and learning from, but also engage with other alternative sources of financing out there to convince them on the potential of these small businesses. Now, everything moves with data, everything moves with evidence. We're just in our third year, and we're taking all these learnings and engaging with different sources of financing to see how best they can pick different. And I can tell you for now, for instance, we've been able to convince a few venture capitalists who invest highly to come a bit lower, right? And we are matching that where we are now, we've moved from $20,000 in terms of the ticket size and are slowly growing it to $120,000. Because now that is the system change. Now you can't have that change happening in the market if you don't have someone that big walking that journey with you. And this is why I tell people that we all have to work together, largely as ecosystem builders, that we demonstrate these things for our entrepreneurs to be able to have access to market. So it's something we're always thinking about. The grants play their part. One of the things that we're now fighting with and trying to change is the mindset of our entrepreneurs. So we are operating in a market where some people have been used to free money, because I'm very early, I deserve to get free money. And we're trying to change that mindset and saying there's nothing like free money. The moment you take my money, you're accountable to me and you have to demonstrate that you either grow in the business or you're paying me back, right? And so we are really waiting to see how this experiment goes, but at least the mind is in the right direction. There's no one doing this in East Africa, I can assure you. And Uganda is the first, where you get your pension fund to focus on these businesses, Patrick. So for me, I'm very excited about the future. Yes, we've thought about investing in companies. We're yet to come to how to do it. We're also learning from some other innovation and entrepreneurship support organizations that are doing it, like the likes of Shona Group, Shona Capital, that are convincing high net worth individuals to co-invest with them. So we're monitoring and trying to see how we could potentially enter that space in terms of convincing all these high net worth individuals, all these entities to actually put money in small and growing businesses. But yes, I think what I know, people are focused on those businesses. But finding the right businesses is still the biggest challenge, because the type of financing we give to the type of business we give, the majority of businesses in Uganda are necessity driven, right? I import clothes, I sell them. That type of business, whereas the businesses we are targeting, even at that level, have to demonstrate that I'm thinking bigger than what I would have traditionally done. Thank you.
Great. Thank you so much, Zulu. Please, if you want to ask a question, just raise your hand. I'll give you an opportunity to. We have a couple of questions in the chat box. Someone had asked for your income, but it turns out it was your contact. That was
I was also,
yeah, but
I was also worried.
I was wondering why. But I think please do share. I think Zulu has shared his contact. He has dropped it in there. Yeah, Patrick is saying that excellent focus. The data from the trial phase is critical. First of all, to prove the concept, so that more people can be able to raise money. There's a question here from Jude. What is the best way to vet companies that seek venture capital? And I think also, as you answer that question, one of the questions we hear on the streets, especially about accepting money from external parties, is people will take your company. And that has been a fear. I think you have had it on the streets. How would you help an entrepreneur appreciate that journey? You say that if you take someone's money, you are accountable to them. What does that exactly mean? And how does, so I've talked to a number of entrepreneurs say, no, I can't accept money from outside because I mean, they'll take my business. So that how should we deal with that perception? And what has been your experience from the businesses you have worked with?
Yeah, thanks a lot for that. Yes, it's a very big worry. Even stealing of ideas is something we hear a lot about. And I believe the entrepreneur is right to be worried for the reason that as much as the potential investor you're talking to is vetting you, you should also be vetting the investor and their intentions. One of the things I have come to realize is that a good investor will want you to be comfortable as an entrepreneur, either in terms of the rights you have once they've bought into the company, the ownership stake you have, to stay motivated and run the company. The aspect of where someone is asking you for a big portion of your company, possibly that's a discussion that is for later on if you really want to exit, meaning leave a company, right? And if you're not ready to have that discussion, then you definitely have to you're not obligated to have that discussion, right? So for me, I would say that I think the first step is to listen, understand the intentions of this investor, vet them. If it means you doing your due diligence on them, please do that. And also you can seek expert advice from entities like Enterprise Uganda, Outbox, and there are so many others. If you're seeking insight into how to hold those discussions, whether what you're being told is right or wrong. So I would say that you're right to be scared, but not the first time you hear that there's an investor, you're that scared, because as I told you, you have to understand the source of financing, the strategic outcomes of or expectations of the investor, and see if there's strategic alignment. So you have to first listen before you come to that conclusion. Not everyone wants to take your company, but they want to invest in the potential that you have. So the best way to vet companies that seek venture capital, I think I mentioned that earlier. So you also have to self-assess again the industry in which you are. Is it attractive enough for a potential investor to come in and go? Can you make money? Are you making money in that industry? your team is your team good enough to take this business forward? I normally tell people that sometimes businesses need different people at different stages. I might be the one who started the company, but I'm not qualified enough to take it to the next stage. So you also have to have that self-assessment, largely if you hire other people to walk that journey with you in terms of how you're growing the company. A proven marketing, proven product in a proven market is very critical. You have to have a product that is working, and you have customers that are buying that product or service. And then your business model in terms of how you're distributing and selling, your cost structure, your partnerships that you've developed are very, very critical. One of the things, though, I've come to notice looking at many company financials is we are having a problem in the market where many business entrepreneurs are leveraging the wrong specialties, largely in financial management, to manage their books. We've looked at books where it doesn't make sense. You look at the income, you look at the cost of sales, you look at the gross profit, and for a business, because we know how businesses in those areas, in that industry kind of operate, it's not really making sense. And I would advise that, as you're partaking of this journey still without a VC, but you intend to raise financing, you have to audit and understand who's managing your books. And the very first thing I advise entrepreneurs to do is you sit down with the accountant and say, tell me about my business. How does it work? That's the very fundamental question you have to look at to really understand whether someone understands your business. All our books might be a bit different. It's not just about developing a chart of accounts, but developing books that actually appeal or communicate your business. Now, what does that lead to if you're not taking an interest is when you share your audited books with a potential investor, they will be rubbished because they don't make sense. There are ratios they run, there's benchmarking they do for them to come and say, okay, I think this is a business that understands what it's doing, right? So please, guys, be very careful about who's managing your books. They have to understand what your business is, and you have to see how is that reflected in my audited books before you're able to share such things externally. It's a very big problem that we are facing, to the extent that we are unable to rely on audited books, but on bank statements to get an understanding of how the business is operating.
Super. Jennifer, I see your hand up. Please go ahead and ask your question. Jennifer, are you there?
No, yes, please.
Yes, please go ahead. You can unmute.
Yeah, thank you so much, Ronald. And thank you, Richard, for such a wonderful presentation. Yeah, you talked about partnership, and I heard you mention that not all the funders, or maybe they're interested in taking your business. But I have a very bad experience on that kind of partnership, getting an entrepreneur. I am a poultry farmer. I got a friend who was interested in the business, seeing my broilers doing well. They said he's coming in. He advised we break my timber constructed chicken shelters, build better ones, which was everything everything was exciting in the beginning. But the moment he put in money, he wanted to influence everything, yet he didn't know about the business. He didn't know how to take care of birds, everything. He wasn't on ground, but he brought in a brother to take care of to take care of birds, would give a decision. You know, we were just keeping 500 and we would manage only 500 broilers, but he said we should bring 2,000. And because he was the funder, I wanted to make him happy. You know, like you said, you have to, when you get out that money, you have to be accountable. So I ended up buying 2,000 broilers, which I couldn't feed. I didn't have enough people to take care of them, human resources. I had to go for a big loan in a bank, which I couldn't manage then. I mean, the whole thing became, and even this person did not even have interest. Me as the founder of the business, I had a journey. There's somewhere I wanted to go. And for him, his interest was only making profits. And, you know, I was helping neighbors start a business. I was helping people around me, the women who cannot even afford food, start a business. For him, he came in with everything different. And I ended up being so frustrated. So please help us. If you found yourself in such a dilemma, how do you come out of it? Thank you.
Great. Thank you so much, Jennifer. A bad relationship with the venture capitalist. I think she has shared with you in her context, but possibly, Richard, you have seen a number which have gone that way. So you could possibly share on that question. I see a question from Dr. Ludo here. He says, thank you for the presentation.
Ronald, you're frozen. I think Ronald has got an issue on his side. So let me try.
What is the current Ugandan legal framework? So, all right.
Ronald, we lost you. We lost you a bit.
Sorry, I think I missed it. But I hope you have seen Dr. Ludo's question in the chat box. You can answer it as
Doctor. Oh yes, I'm seeing.
You ask, as you answer, Jen. I'll give Joram an opportunity, and then you will answer all questions at the same time. Joram, please go ahead.
Good morning, everyone. Thank you for the opportunity to share my thoughts. Thank you as well, Richard Zulu, for your comments and your presentation. Mine is just a comment and not really a question, but I just wanted to bring it up in a way that we are trying to get our entrepreneurs in our ecosystem to become more investable ready. We're trying to connect them to venture capitalists who have set a bar so high and they can't meet it. So I was just thinking earlier in the morning around the conversation, what's happening on the call this morning. And I'm thinking, how do we now start to get entrepreneurs to sort of like leverage all opportunities we have in technology to be able to digitize their supply chains and their value chains? Because I think in my own thoughts, innovation is not just about having a new product or new service in the market, but it can also be about how do you innovate around a new process in an organization, a new process in the ecosystem, which has not been done before, which will be new and which will introduce people to a new experience altogether. So I'm thinking, is there a way we can start also pushing our entrepreneurs and our, the people that we serve to sort of like start thinking in new ways of digitizing the supply chain? How can we get that farmer in the lowest parts of the communities in Uganda to think about how can they get their products and services onto a digital space where they can be able to access new customers and new opportunities, which will finally enable them to be able to become investable ready. That's my comment. Thank you so much.
Thank you so much, Joram. And I think that's a conversation which we might even have to do an entire session for. But it's a brilliant point which you have made. How do we get the businesses investor ready? I know that Zulu has up to the top of the hour, so I'm just going to allow Richard or Wundo to ask, and then I'll ask Zulu to share. Richard, please go ahead.
Thank you very much. Thank you very much, Richard, although I joined the call a little late. My question goes to, in relation to what Jennifer asked and what Richard, you had just talked about previously. I know that many times our businesses are started, even if we register, for example, companies, you find that it's almost run almost like a sole business. In most times, you find that the company is not even differentiated from the person who has actually started it. And just like Jennifer was explaining, you realize that it is you, the individual who has started it, who mainly understands all the corners of the business. I wanted to just know, or maybe to get from you, Richard, for example, if I reach a point where I feel like I want to maybe bring in a potential investor, at how do I realistically assess the business worth of, the worth of my business? Looking at, for example, sometimes we mix personal finances together with the business finances. And for us, for example, when you're also in employment, you may even be thinking the business is realizing profits when actually it is not realizing profits. I also have almost a similar experience previously, like what Jennifer just put. I had a business venture, which actually friends admired, and they reached a point of even putting in money. But this was a very, very close friend whom I would not want to lose. And the time reached, the business was doing well, but the level of effort this person puts in is almost zero. It was a business that required a lot of supervision because it involved the little things of manufacturing and what. But all the person would focus on how much money have we made, how much money have we made, even if you try to bring them into put in some level of effort. I just reached a point and told the person, because I didn't want this thing of saying we started the business and then my friend took it over. I just said, you know what, I'm tired of this business. Let's close this chapter. And that's how we closed the whole chapter and everyone parted ways. So I just wanted some guidance on a business where I feel like I've reached a point where I need to grow it and maybe bring in more funders. How do I assess the whole worth of my business before I determine how much a share would be? And if a person brought in, for example, 10 or 30 or 100 million, what would that percentage be in terms of the shares I give to that person? I thank you.
Super. Zulu, over to you.
Okay, thank you very much for the questions. So let me take a stab at them. I'm going to look at Dr. Ludo's question first around the current legal framework, which will move me to the question on bad relationships. So in the venture capital industry, we have structures and engagements that we undertake collectively in terms of looking at the legal regulatory framework. So we have what we call the East African Venture Capital Association, EAVCA, that has venture capitalists as part of the membership. So through EAVCA, we seek to lobby and and see how we can influence regulation. For instance, some of the regulatory areas that we've been looking at or considering is around the competition bill that was tabled by Parliament, which largely talks about how investors can have controlling interests, minority shares, so forth and so on in businesses. So the question is how we were asked to provide opinions on that and how it might influence. There are other regulations like the Partnership Act of 2016 and even the Capital Markets Authority Act, where we're trying to see how foreign investors can be incentivized and also local investors. So there are a number of regulations that touch on this aspect of ownership, controlling, but also incentives for investors that we're trying to kind of motivate. So that's one of the areas that we are passionate about, but it's IAVCA that really drives that discussion on our behalf with our participation. So the initiative is happening to kind of address these kinds of issues. Now, a bad relationship with an investor, I won't lie to you. Those things happen all the time. It's most likely not only you who has been affected by such a relationship. And unfortunately, many times, because, largely if you're a first-time entrepreneur, it happens and you don't know who to turn to or who to ask for insight or help before you even make some of these decisions of people coming into your business and making these demands. So one of the things I would say is I would encourage entrepreneurs to look at these entities called innovation and entrepreneurship support organizations. And Ronald is running one, Enterprise Uganda, and there's so many others, like Outbox. There are close to 30 of them in this market. You find one that you believe can assist you in terms of how you go about these things. But ideally, if you are a second-time entrepreneur and you're faced with such a situation, one of the things that you normally agree to when people are coming into your business is there's what they call a term sheet. You're giving me this money. What do you expect? What am I giving you in return? If you're giving away shares, then you have a discussion which is documented in a shareholder agreement. And then you have clear roles and responsibilities in terms of you're coming in because investors sometimes want to play a part either in the board, most likely in the board, or how you hire. That is usually expected, right? And of course, you have to have alignment, with saying for us, I'm a small business, yes, but I don't just hire anyone. Okay? We have to agree on who we are going to look for. And it's not necessarily your brother who may have that skill set, because also that raises a lot of conflict of interest issues, right? So largely at the point of investing, if you are to do this again, is where you try to align with someone coming into your business. Of course, alignment is to protect yourself if you're to ever go into a mediation or anything like that. When you're disgruntled at this point in time, you have a fallback plan in terms of how someone can stop being that influential or involved in your business if you see they're not providing the value that you want. But of course, they always negotiate for the best terms. And I think it's up to you as an entrepreneur. Negotiation is a skill that you build through practice to see how best you can push back on some of those things. But these are usually demands made by people who put money in terms of expected returns, in terms of who you hire. And at the start, you really have to be very clear in terms of what you think or what you believe your process should be when such things happen. Now, even when you do all that, these things can still happen along the way, to the extent that you can even go up to mediation in terms of trying to resolve conflicts. But the worst thing is if you don't have anything written down that you can refer to. You even have to ask yourself, how did this person come? Did they just give you money as debt? Did they give you a debt that turned into shares for their shareholders? What rights do they have to make some of the decisions they're making in your business? All those are things that if you are to do this again, you should really look out for before you bring in someone. So as much as they're vetting you, I know there are times you need this money badly, but at the end of the day, if you don't cover your bases, be it a bank, be it a person, people come back and take advantage of you to the later based on what you signed. So yes, bad relationships happen, but the ability to resolve them amicably is also Very important, but also having some fallback position if you're to have some conflict resolution on something documented is very critical. A shareholder agreement, a term sheet of what you agreed, and also the roles. There are roles in companies. There are shareholders. You have no business in the company. You just bring money and wait for your returns. And then you have the directors who manage the direction of the company and account to the shareholders. And then you have employees. Directors might also be employees or not in the business. So that separation of duties as you grow is very important. The fact that you attracted money just demonstrates that you are at a point where you're growing. So even guys, as you're growing, you have to keep thinking differently. You can't keep thinking that the way you used to run business is the way you should keep running it. On the digital side of things, I must tell you, Joram, it's a challenge, but it's something that we just have to constantly keep working on. We've seen that one of the biggest barriers to adoption of technology for businesses, even if it's just managing your financial records, first is the cost of access. The devices that are required are still high in terms of cost, and the internet, the cost of internet. We have to find a way of, our government has said they are finding ways of trying to reduce that, but I feel it's very prohibitive. So here you have an entrepreneur who has a phone. The phone might have like 5 GB of space. On those 5 GB of space, this person is running business on WhatsApp. Then as they're growing, they have to look for space in that same phone to install an app to help them manage their financial records, and maybe download some learning materials. So already there's constraints because now they cannot afford to buy a better device to help them run their business. So we really have to address some of these barriers. The second barrier is digital literacy. Digital literacy, one of the things I've learned is driven by also data protection. A lot of entrepreneurs currently fear who has access to my data, right? And I think that drives also the way they manage their books and how open they are in the operations of their business. So until they understand that if I use this tool, this is my data, I have control over how I declare to URA, I have control over how I declare to so and so, but this is for my benefit, and that is driven by digital and data literacy. So there've been a couple of initiatives to train entrepreneurs. We had one at Outbox during COVID where we trained close to 300 entrepreneurs in different sectors, from salons to tourism, so forth and so on. I know Federation of Small and Medium Enterprises has had something with UCC, but it's a journey. It's a journey. It's a very hard thing to answer, but I think we need to just keep at it for more and more entrepreneurs to learn how these digital tools work. How do you value a business? Now, this one, how do you realistically bring in an investor? How do you value a business? So when you're really starting a business in the very early stages, it's not as easy to put a valuation on it because you've just started. Your revenues are small, and many times we just write share capital. We just say, it's 1 million, it's 5 million. We don't know how all these things kind of affect the valuation of a business. So what some people do at the very early stages, we have a concept called sweat equity, where you're like, okay, if I am bringing in Joram, Joram, I like you, I like your talent, I can't afford you, but based on the market rate, I have to be paying you 5 million, but I can only pay you 1 million. The other, can we convert it into sweat equity that maybe 2-4 years down the road, we can convert into shares of the company at that valuation when the company has grown. So you sign an agreement and you sign milestones for Joram and outcomes that he should demonstrate in the different periods of time to earn that sweat equity. And then you keep working. And then when the company has grown, you then run a valuation and then give Joram his sweat equity if he has met the conditions. Now, in the very early stages, it is, I was reading even some research, and this is something we've seen. As a very early stage business, it is even very hard to rely on your projections. Most people don't give you money based on how nice you've projected the next financial years, because close to 70% of businesses never meet those projections. So people look at your cash flow to kind of determine your valuation of the business. And then they also look at your potential to unlock more revenue based on the contracts you have, how much have you fulfilled and how much are you unlocking. Then later stage is where these different valuation mechanisms come into play. There are very many valuation mechanisms. I won't get into that. Venture capitalists run. But I think for you, at the very start, you want to really grow your revenue. That's the price. How am I growing my income? And then use that as a starting point. In any discussion, you can go to Ronald, you can come to us, and then based on the discussions you're having, we can help you kind of identify what type of valuation you can put to your company, right? I can give you an example. For instance, if right now under NSSF High Innovator, we invest $20,000 under what we call a simple agreement for future equity, meaning in the future, if this business demonstrates certain milestones and potential, we shall convert the investment into equity. Now, if someone has given you, but we don't take the equity at that point, we take it if the business demonstrates certain milestones. So imagine if this business has a safe 6% for $20,000, already at 100%, you're looking at this business being over $1 billion. Right? That already is an indicator for evaluation that a business can put to itself, right? So there are very many ways of looking at valuation, but you also have to know the stage at which you are and what valuation method to use along the way. I would advise in the very early stage, if someone is not bringing hard cash, like hard cash you can put into share capital and do a proper analysis of that, then you have to rely on sweat equity. And Ronald, I can share some materials that you can pass on to them for that, around how to do sweat equity that they can read and understand.
Super. Lovely. Thanks a lot, Richard. We will look forward to those materials. We'll share with everyone on their email. As you registered, you shared with us your email, so we'll be able to pick that up. Richard, we have had a lovely time. Thank you so much. We know you had up to the top of the hour, so it is such an honor that you have kept with us up to this point. Richard, I'm going to request that once again you share your contacts. Please reach out to Outbox. You can follow them on Twitter. You can follow them on LinkedIn. They have a number of products. I believe that I hope you captured the fact that Richard mentioned that even on the NSSF program only, I think you said about 150 businesses have been reached. What that effectively means is that there is opportunity to recruit more. And for us, it would be great if some of you can be able to use this opportunity to get onto the program with the joint program with NSSF and Outbox, which MasterCard, which Outbox is running. So we are looking forward to hearing more. Richard, it has been a very insightful session. We are excited about what you have said. As Richard mentioned, this is a journey, and there are a number of partners in the ecosystem who are doing this kind of work. There are some who are focusing on tech, some who are focusing on agribusiness, some who are focusing on specific industries. So for me, what is important is to reach out for help. That when we hear the horror stories of things which have happened to entrepreneurs, and you ask, do you have a document? At least the first thing someone will tell you is write down something brief. It could be even with a friend who says, I want to give you some 5 million. Let there be a paper written. What are the expectations? Have those conversations before. It's very, very important that it happens, and that kind of mitigates the risk. And Richard has ably shared that in his presentation. Richard, send our greetings to the team at Outbox. We are very honored that you gave us this time. Thank you so much. And the entire team which joined us, we are very, very glad that you joined the call today. We look forward. We'll be back next Thursday with another topic. All of you have joined, you're in our database, so we'll send you that information. It's always an honor to just come together and move. I see a number of people who are on the call who are in this space. Kenneth from Tech Buzz Hub, that's another place you can go to be able to help. I think, yes, we heard from Duga, and Duga is also one of the people who are in this space. There are some who are individual consultants who are within organizations. So please reach out for help and find some help. Andrew, I see your hand up. I have just 1 minute left. I don't know whether you want to make the last comment. Andrew Semakula.
All right. Thank you, Mr. Ronald. I had a quick question. I wanted Mr. Richard to help me. And I would also want to applaud him for such a wonderful discussion for us. So my question is, I so happen to have started it. I got an idea that I shared with the friends. So they bought it up. And there it happened. I decided to get some funding strategies, of which I decided that we shall be contributing a certain amount every end of the month. So one of the colleagues, he has gotten his income is a bit good than us. So he's much willing to contribute more in claim of goodwill. So I want to ask Mr. Richard, is that can we tolerate that? Is it ethical right in business?
Thank you, Andrew.
So this person wants to contribute for goodwill. He wants to bring money and call it goodwill without any return or shares or anything.
My reading from Andrew is that he's contributing a bit more than the rest because the one with a big salary. Yes. And he's saying, me, that's my goodwill to the business. Richard, you can answer that as you say bye to us.
No. I think, I don't know if he has written it down. I think that's the starting point. If he's just saying, I think you have to get him to write down that this is a grant that he's giving to you, and not to expect an investment, because the debt always comes due if things are not clear. So you must get him to write it down and commit that it's a grant. Otherwise, it has to go into either debt that you have to pay back, or share capital for the business where you have to give him shares. So just align and formalize it urgently.
Super, great. Thank you so much. Richard, asante, thank you. Please, Andrew, you can reach out to Richard, send him an email, some of these specific questions, so that you can be able to get any further guidance. Team, thank you so much. Have a lovely day. We look forward to having you again next Thursday. Have a blessed day.
Okay, blessed day. Thank you.